Yeah, no, we got to get going. Apologize. Yeah. All right, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Good morning, Pip Pirates. Arr! My name is Wayne McDonald. I will be your guide on this thing called Forex, this journey we call Forex. Let me know where you want to go. I recommend today we cover gold, oil, Bitcoin, the stock markets, dollar pairs, yen pairs. Yep, that kind of stuff. But you let me know what you want to do. You're the boss. I am a humble servant. In the description below the video, there's a link to my book, Strategic and Tactical Forex Trading. You probably already own it because I wrote it well over 10 years ago. So maybe leave a review. The second thing is next week I will start writing my next book. Yeah. Macroeconomics. Cool. In the description below the video, there's a link to my community, fxbootcamp.com, $88 a year. Also, then below that link, there is another link to tradersway.com. That's the foreign exchange broker I recommend to you. Fast execution speed, narrow spreads, huge swaps, lots of amazing assets. We're going to go through all the stock market indices around the world on the Traders Way platform. Pretty amazing. You can have MT5, you can MT4, you can have C-Trader, lots of choices, but mostly the way you should choose a broker is you trust them. They've earned my loyalty and respect. If you open up a demo account, maybe they'll earn your loyalty and respect as well. Tradersway.com. Okay. Let me move this around. I can't quite see the chat here. There we go. All right. All right, hang on. I got to... Cool. I need to move my phone. Anyways. All right, yeah, so today's the last day of the year for trading. So, Happy New Year. I don't want to start with commodities. Let's start with stock indices, unless you choose something else. Okay. Let me do stock indices. I'm a bear in the U.S. stock market. And what we covered 24 hours ago. Oh, let me get my drawing tool. What we discussed yesterday, remember I drew this out. The idea is we do have support there, obviously, triple bottom. We played this price before, if you noticed, like this area. And then, of course, we repeated here, and then probably this. It's all the same. So we've been in this mess before. So that's the support, and the resistance is the distance between these two moving averages. Okay. And so I imagine this will squeeze and then break. That makes sense? What do you guys think? Well, last night in the swing trading group, we discussed the likelihood of the down, but the catalyst for an up, and in particular when. Okay. Cool. Today is the last day for an investor to take their loss and write it off in their taxes. Now, don't forget, stock indices around the world have already closed, like Hong Kong is already closed. DAX is already closed, for example. And the German stock market ended the year negative 18. Negative 18%. Looks like it was a lot worse, but there we go. Oh my God. But you can see all it did was drop 50% from the top, from this bottom to that top. And you remember this rally was BS money to begin with. The currency in mine only displays a horizontal line. What? Well, let me just quickly show you that and I'll go back. This one gives you a horizontal line. Okay, this is how you adjust the value. Now, if you have like an ECN account or something like that, sometimes they put suffixes on them. So sometimes you'll have to add like an I if you're trading I Euro USD or something like that. You'll have to add that there. So anyways, we had a pretty tough year, right? And does this market look like it's out of control and unpredictable? This is the German stock market. It's a great trading instrument, by the way. Well, we started the year at M3 and the year's low, okay, so this is the M2. The low is S2. And then we closed at the new central pivot point. Does that, I mean, there's a lot of volatility in this because it was way down, then it was way up, then it was way down, then it was way up, then it was way down, then way, way, way up, and then it was down. Lots of vol. But does that look out of control? Does that look like randomness? Yes or no? Remember, if it's randomness, you can't trade it. If there are patterns and logic to it, you can trade it. Okay. Oh, hey, Aaron. Yeah, Aaron, I think all you need to do is sign up again, right? Get your annual membership renewed at $88 a year, and then upgrade your account to the swing. Easy peasy. So yeah, it is not random at all, and even in a tough year for many. Remember, most hedge funds lost money this year. And I look at this and like, okay, I don't like the volatility for sure, but there is a lot of logic here. There's a lot of trades here. Okay, and that brings me reassurance. This is not out of control volatility. Okay, now if you're a technician, you're going to look at it this way and you're going to take it north. If you're a technician. But then again, as a technician, you don't have an opinion whether the stock market's going to rally or not. Yeah, but, Aaron, I that's what I sent you email. That was like a year and a half ago. Your annual membership expired. So the good news is it's $88 a year instead of $382. Boom, boom, boom. Okay. So it's even cheaper. Yeah. Oh, is that right, Greg? Yeah. Well, you and I know better just from sitting here for so long. It's random to those who lose money. So anyways, look, if you're a technician, that is bullish. That's that. If you are using some other form of analysis, you might have a different opinion whether this is going to be bullish or bearish because you're not making your opinion on technical analysis. So if you were like, for example, you came to some fundamental conclusion of bearishness, you'd look at this and say, well, you can't be a bear now. Okay. No, Aaron, it was 2021. So it expired in April 2022. It's December 2022. Yeah. No, it expired months and months and months and months and months ago. But again, it's only $88 a year, man. Which you remind me, I should put it back to 382. That's still fair. But anyways. Okay, anywho. Who? That's what it says here, technically. If you were going to be a bear, though, what you want to look at is, oop, sort of more like this, oop. And then somewhere along the line, which is a management decision, do you sell here or do you sell here? Okay. Okay. Take a look at NASDAQ, even more sensitive to higher interest rates. Okay. Okay. Came up into the sell zone. Remember, let me define this again. It's always good to be clear. This zone in here, oops, let me make it a little fatter. Okay, this zone in here is for selling. Okay. And the nice thing is the way that I teach you is you can't even think about buying. It's not even possible. If you're doing this type of analysis, you get you receive freedom. You're free from thinking, what if it goes down? What if it goes what if it goes up? What if it reverses? What if this and what if that? You get rid of all of that. All of that noise only leads to stress and probably poor decision making because a lot of people don't perform well under stress. They just panic. So if you just remove that from even a possibility, then there's no chance of you thinking about buying or thinking about what if it reverses and what if this and what if that. It's sell or don't sell. You sell high or you don't sell. You sell at resistance or you don't sell. Right? Isn't that better? What I tried to do is teach you how to have clarity. Clarity is important. Cool. Does anybody need the link to the 2023 outlook next week? I'm going to spend the weekend putting together the research and the presentation. The holiday weekend. Does anybody need that link? I don't even have it in front of me, but I can try. Not that one, not that one. Is it this one? No. All right, I can get it for you. If not, I'll just email it. Grind says, some might consider that a higher high, higher low. I don't. No. See, for example, Grind. Right? Let's bring some clarity. Okay? The 21 is below the 55. There is no higher high. Okay, this high is lower than that high, and that's that. Now, I know you're saying it's higher than that. Okay, but I'm not looking for the reversal. So right now, Grind, you sell in here or you're not a bear. It's that simple. That's it. And if you consider that a higher high, you're a bull, but you have a very high probability of losing money. Okay? Yeah, enough said. Yeah. And again, sometimes it's a little dumb. Like I'm trying to simplify it, to the point where maybe it's oversimplification. I don't know. But look, I can see this too. I can see that. And someone might do this, and right? And they might make money. My point is I'm not teaching you that. Okay? If you sold up here and it comes down and hits this and then bounces up, you don't lose any money. But we didn't quite hit the weekly target. We didn't quite hit the monthly target. It's not the right zone for a reversal pattern. I don't really care about the pattern. I care about the why. Why are people taking profit if we haven't even hit targets? And then I also think about it. Are traders going to load the boat the last day of the year, or are they going to exit? I think more exit than anything, but who knows? Let's see if I can get you that link. Products. I was standing. You were there. Two worlds collided, and they will never tear us apart. Boom, 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 boom. Okay, let me double check the link here. Yeah, there it is. Okay. Yeah, in excess, faux show. All right, yeah, so I'm going to spend the weekend, a holiday weekend, working on a presentation for you. So chip in and buy me a bottle of wine for my time, huh? And not a $10 bottle of wine. I'm gonna, yeah. Chip in for a bottle of wine. Yeah, well, thank you, Meta. I told you that we can fly high because we all got wings. All right. So, yeah. All right. And Euro not doing much. So there's the stock market. Okay. The stock market just opened in America. Okay. Looks like somebody's trying to get in on it. Huh? Get some moves the last day. Wait, I don't want price action pivot points. Cancel. I want insert indicators custom. I want biased pivots. You want to take it north or sold? Yeah, let's go bearish and see what it looks like. There we go. So there's the sell zone if you're a seller of the S&P 500. The buy zone is where we're in now, obviously. I mean, look, I can just switch it, right? Watch. Biased pivots. Bullish mode. Pachow! There's your buy zone. So you knew this. You knew this yesterday. If you're a bull, that's what you're doing today. Details, please. What details do you need to know, Jeff? I will predict the entire year month by month. Yep. Any other questions? I did it last year. It was pretty all right. Yeah. Why would anybody buy that? It's the same as tech. Yeah. Well, but it's not the same as tech in the sense that tech is more negatively impacted by higher interest rates than S&P 500 companies. So you could say, you know, NASDAQ has a higher beta. Okay, because of additional levels of leverage, if you want to look at it that way. So on down days, you might sell NASI, and on up days, you might want to buy the S&P. Now, what that means is on the up days, the NASDAQ's going to make more money, but maybe you're looking for, you know, faster profitable moves for selling and then actually buying and holding on on S&P, but whatever. Yeah, they're very similar though. I don't mean to be so nitpicky. Greg's not buying stocks for another 3 to 5 years from now. Oh, that's interesting. Save your powder for later. Yeah, okay. I mean, I get it. I sense now that that's too far out. But, you know, I think what you're saying is if the stock market moves sideways for 3 years, you're going to skip the volatility and probably end up with the same price. So would you buy, Greg? Would you buy a 3-year bond and earn 4% a year? A 4-year treasury priced in USD? Hey, 4% a year? Maybe? Okay. All right, so I want to show you this. Okay, I'll show you this. Okay, look at these prices right now that we're bouncing around on the open. Let's put it on like a 1-minute chart here. Interesting, right? Let's delete this. Do you think these prices here were known by the market? Yeah, Greg said yeah. Well, you know what I did, Greg? I bought a couple of mining stocks that are paying a 10% dividend. Now, obviously, it's not risk-free like a bond, but they're big enough companies where they have mining concerns in like 25 different countries around the world, right? And they have many different types of commodities. The ones I really liked were like copper and cobalt. So it's not a bond and, you know, certainly not risk-free, but ooh la la, 10% dividend is quite pretty, huh? So I'm going to hide out there for a while, for example. High income commodity plays. So what I was saying 6 months ago, maybe even longer than 6 months ago, I want to start buying old world economy type companies, old school stuff, like digging in the dirt type stuff. Like they actually do something tangible. Because you look at it like, okay, here's a company that's been digging copper out of the same hole for 40 years. What's the likelihood that they're going to dig copper out of the same hole next year? As close to certain as possible. And what about the next one? Almost as certain, right? And they're going to dig out approximately the same amount using the same equipment, using the same people. So you get, you know, a pretty predictable expected return. Which you don't know, of course, is what will the selling price of copper be, but they're market takers, not market makers. So I'm betting on that they're going to dig, they will have the capacity to dig shiny stuff out of the dirt and be able to sell it for at some price, and maybe even a great price if some of my other predictions come in. So if they're willing to like basically have me invest into them and then they pay me 10% income plus asset appreciation because I'm a part owner of the company now, well, shoot, it's pretty attractive, right? Yeah, I got Rio Tinto and BHP. Hang on. Let me do stock price. It's Yahoo. By the way, does anyone else have this issue now? Like, I got a Windows update, and every once in a while, I will type into a Google Chrome browser, and it gives me search results on Bing, which is a Microsoft product. But I didn't use Bing. I don't like Microsoft. But it does it now every so often. I'm like, what the heck is this? Yeah, well, Arve's in Linux, yeah. No, but it doesn't. Maybe, but it only does it sometimes. Yeah, but it's weird. Like, it's just really bad. Just again, what kind of person at Microsoft thought that that would be a good idea? A bad person. Anyways. So I bought it about 6 months ago. Probably more like, well, I'm a buyer, what? When did I say? The third week? Somewhere between the third week and... I owned it for a while, so I didn't buy it in October. But remember, one of the things we said is the market would rally. Well, let me ask you. When did I say, in January last year, when did I say the stock market would rally in 2022? Why don't you tell me? In January of 2022, when did I say the stock market was going to rally? I said, normally it rallies here, but definitely not this year. Then I said, I always buy in this other period, but not this year. And then I said, this is when it's going to happen, which is very, very, very unusual, but that's what's going to happen this year. Kevin's right, before and after the election, a couple of weeks before the election. So we're talking like middle October, right? So middle October is, let's say there's October 19th. Now, I don't remember when I bought, but it was somewhere in that window. So I bought it. I don't even remember the price. Let's say I paid $50 for it. Now it's 62. But the thing is, what I wanted to show you is check this out. Okay. Now, if you invest $65, you're going to get $6.50 a year in dividend payments. But the thing is, I didn't pay 65, I paid 50. So my effective yield is even higher, right? And Yahoo says this is going to be a $70 stock. So I would get $6.50 per share for a stock I paid $50 for. But they're saying the stock's going to go to 70. So I make 20 here and 6.5 there. So I make $26.50 if that projection's right on a $50 stock. So that smells like a 20, what? Well, I make 20 here and 6.5 there on a $50 stock. I make $26 on a $50 stock. I make $26 on a $50 stock. I make $26 on a $50 stock. Yeah. So that, like, all I'm saying is I understand Greg, and I'm like, yeah, I thought about it. And that's what I did. Instead of buying a bond, that's what I actually did. And I did this for Rio Tinto as well. Okay. We can go back a little bit. So I bought it in here, again, around $50. It's 70 already. Okay. I bought it at 50. It's already 70. But then we go down and we look at this. And you're going to, if you bought it now, you're going to earn 9.62% a year in interest payments. But again, that's if you paid 70 for it. But if you paid 50 for it, that's over 10% easily. Okay. Right? So I've made $20 plus this, right? So again, $26, $27 on a $50 stock. That's a pretty good year, right? Especially in a down year. You see this, guys? Like, in a down year where the German stock market's down 18% and the NASDAQ is down 30%, you're a rock star if you're making $26 a year on a $50 investment. Don't you stink? Yeah, Greg said in the past you bought money stocks. You got to sit them on. Well, but you got to look at them as a bond. No. I'm saving. I'm waiting for next week faux show. GE is also a great share buy, but I don't like that company. They've divested out of so many of their businesses, and they got to be such a conglomerate that they became slothy, if you will, definitely not entrepreneurial. And so they've divested out of many of their old businesses and this, that, and the other thing. Like, I don't know if I don't even think they're the same company anymore. If I could get into something more specific, like, the division of General Electric that, makes generators for nuclear power plants or something like that, right? But, nah. Is that right? Yeah, see, like, it's so complicated. Like, is it a finance company? Do they make electric motors? Remember, they used to make appliances for your kitchen, you know? Are they in media? It's just too much of a conglomerate. I don't know what I'm buying, you know? I need a very specific play. So like with BHP and Rio Tinto, part of my play as an investor and owner of the company now is that they dig cobalt out of the ground. And I think there's going to be a shortage of cobalt in the next 5 to 20 years. And whoever can get it is going to get very high prices. Well, these companies have been digging stuff out of the ground for hundreds of years. They already have their concerns all around the world. They already are digging the dirt. Very few people can just very quickly get a project up and running and start getting cobalt. Let's go get some cobalt. Well, you got to be able to own the land or lease the land, and you got to have connections with the governments and for permits, and you probably have to bribe the heck out of people. Well, all of that stuff's been done in the case of BHP Minerals and Rio Tinto. Now, you can get smaller players, but they might have smaller concerns. They may have less leverage with local governments and all that kind of stuff. So I'm thinking there will be some other players. But I think when it comes time to maybe these companies need to access, the credit markets to borrow money to maybe get into new projects or expand current projects or something like that, the big guys are going to get the money more easily at better prices and cheaper rates. And you want to go with an 800-pound gorilla, not just one small company that has one or two concerns, and your whole bet is that they don't screw the company up, or overspend, or can't access credit, or can't access the supply chain because the big boys are buying up all the ships and stuff like that. So I'm like, you know what? I don't want to go with a small guy. I want to go with someone that's been digging in the dirt for hundreds of years. Yeah. So that's kind of how I went with that one. So it's a bond, but I do expect commodity shortages, let's say 5 years from now, when the global economy is booming again and everybody's trying to get, everyone's buying an electric Volkswagen, an electric Toyota, an electric Ford, electric Chevy, an electric Tesla, electric Porsche, electric Ferrari, electric Lamborghini, electric Kia, electric Hyundai, electric Neo. And what? Well, that's a lot of electric cars. And I don't think anyone's thought it out how do we make the batteries for that many cars? Okay. So anyways, that was my thought. I had the same concern as Greg, and that's the play I made. It is what it is. I'm done. It's done. But those stocks are up at least 10% this year. Plus, I'm getting 10% back from them. So 20% a year is pretty good in a down year. Okay, here's the play. This is just the noise at the open here. Just all over the place. It's why I don't trade in the sense that I follow the market like, oh, it did this, so therefore I got to do that. No, that makes sense, and that technically is what it says. But knowing if you're a bull or a bear here is so much better. Okay. So for example, let's look at what right? On this higher time frame, on this day, the market turned bearish. On this time frame. Now, obviously, you could see this was coming. Okay? And there's 3 steps along the way in which you could put together a bearish play. Okay? This is you now forecasting. Double top. Okay? Came down to the support area and then breached that. So you had this 1, 2, 3, 4, 5, 6 day drop. Okay, so could you have sold the double top? Only if you could have predicted it as a bear. Now, it just so happens you'll see an orange line there. Okay, my super secret fundamentally based alert service predicted that for us. It said 4107, and 4107 was right. Cool. So you could have. And then somewhere on this drop or the follow-up, because you can see after the drop, there would have been an up and then a down, right? You see? So you could technically be short here and here. If you recall, I think it was about this day. It might have been in here, but somewhere in that void, I expressed that I took profit on some of my stock positions. I went to cash. Because the other thing, if you go back to my January 2022 prediction, we also talked about the second week of December, in which I would plan on exiting any long positions. Oh, so I did. So in that case, some of it I went to cash here. I'm also triple leveraged short. Not fully, but I do have a triple leveraged short position. And then I added to it, so I got a little more triple leveraged short to try to offset some of the down. Now going to cash is also offsetting some of the down risk. And maybe later in the year, I can exchange that cash for an equity position. Oh, he probably needs for the presentation. Let me get that. I think it's this. Okay. Cool. So nonetheless, you can have, right? When do you kick in? Well, what we're trying to do now, when you're, so like I drew this line, this area here yesterday, right? And what I expressed yesterday is that you're trying to figure out where this is going to be in the future. Okay. So like you could say, well, this is moving this way and this way simultaneously because it's a downtrend. So over and down, like step flashing, right? And this is dynamic. So this whole thing doesn't stay there. In a few days, it'll probably be here. Okay. So this will be a slightly lower and slightly down. So you can imagine like you need to look at it this way. Okay. One way to cheat is you drop into the 4 hour. Okay. And the 4 hour 55 gives you that number. That's what it's actually trying to help you do. And that's why I say this whole area, if you're a bear, this whole area is where you sell. This whole area is where you sell. This whole area is where you sell. And everybody else loses money. So, like, watching the stock market on the open, to me, is quite silly. You're like, really? That's what you do? Trading the stock market open is fun, and it's the right time to trade. But if you're literally just trading the volatility of the open, I made this point at, I wrote an article for FX Street a month ago. Okay? And what I wrote is that to a professional hedge fund manager, vol is bad. Volatility is bad. So if you're trading the open on a 1 minute, 2 minute, 3 minute, 5 minute chart, and you're like, oh, it did this, and then it did this, and then it did this, and you're just loving that and you're trading, you're doing the opposite of what a professional would do. So by definition, you're an amateur. Now you're like, but wait, I'm making money. And okay, great, cool. But nonetheless, a professional investor is doing things in their strategy to lower the volatility. Okay? You see? Or what if you said, because of the technicals on the 4 hour, and remember, we had assumptions of this happening 11 months ago. So the technicals are only confirming that assumption 11 months ago is correct. The market conditions that I predicted do indeed exist. That's all this is. So think about that. I either know the future because I can travel through time, or I'm a genius and I can put together thousands, if not millions of variables and organize them in my brain and therefore can predict the future. Or there's normal patterns occurring that are fairly easily predictable. Which one do you think it is? If I can say, oh, this is going to happen 11 months earlier. 11 months, dude. Okay. Well, facts are facts. You can't, right? You can't travel through time faster than the speed of light because you will be destroyed. Now, you'll show up in a different time as an infinitely long strain of atoms. But let me tell you, that gets uncomfortable very quickly. The second one is I'm a genius. But I can tell you, going to Harvard, I'm a bumbling idiot compared to a genius. I'm an idiot. There are geniuses at Harvard. I'm an idiot. So then there must be a logical pattern here that can be understood. So I can train you and then you would understand it. And that's the whole point. Okay? All right. So there's something else going on here. So when you open your charts, you look at it and all it just confirms is, yep. Now those are the conditions we would expect in this situation. So now you have to trade accordingly, right? Right? Cool. So then what if now we drop into a 1 minute chart? And because of this logic, you could only short. Based on your own rules of engagement, no matter what happens, you either short or you don't short. You're probably better off, right? So we'll go back the way I had it initially set up. Biased pivot points, bearish mode. Okay. So that's why I created this indicator, by the way. For it to produce the right information for you, you have to tell it, are you a bull or a bear? Okay, I like that a lot. That's why I like this tool. You must tell it, are you a bull or are you a bear? Okay, beautiful. And it takes out all the other extraneous information. Okay, so let's look at it on a 5 minute chart instead of a 1 minute chart. Okay. This is the M3, which represents the best selling price of the day that a bear could possibly think of or expect. That's the best bearish selling zone price. The second best is this one. Best, second best. Is that helpful information if you could only sell? And then also, while you're answering that, let's ask, do professional traders, institutional investors that do trade the open, that do have complicated algorithms, do they have this number in their algo or in their analysis? What percentage of S&P 500 traders said 3, 8, 28? So, what are the key takeaways? You trade the open with more than volume of volatility. You got to be more than just a vol trader. And you got to think bigger. You got to look forward, let's say, with leading indicators, right? And you got to understand the context of where we are, not in the minute, but at least in the day. Okay? And in the day, this was the most important thing to happen today. You see? That's the most important thing to happen today, like this day, and like this day. Okay? And so is this area here going to make you or break you? You're going to lose a lot of money there? Really? Can you see sort of the silliness here? Now look, a bull is going to try to buy it somewhere in this zone. A bull is thinking this. There's no doubt about it. And they might be right, but probably not right. Okay. Okay? Probably not right, but someone was probably going to do it. What would be more interesting to you as a bear is kicking off the moving averages. So what happened last time? Well, we tested the 55. We came down, and it took 1, 2, 3, 4, 5 more candles. Okay. So what you're looking for is that. Yeah, I got you, Greg. It's such a great indicator of sentiment, right? But it's so small of a hill of beans. But it's the funny thing. It's like that's what everybody cares about on watches, but it's so small. So, you know, I was listening to a guy talk about the real estate credit market, the private credit market for real estate. So imagine a skyscraper in New York. They don't go to a Bank of America and get a mortgage, right? So they raise a bond and all that kind of stuff. So an investment bank is going to help you raise a bond, and it's a credit investment, right? And you know, but it's kind of like a mortgage, right? But anyways, he was saying that market, think of it, the bond market, essentially it's an asset-backed bond because the skyscraper or the apartment building or whatever it is, it's an asset plus it produces income. Okay? So you could raise a bond for it. You don't even need to buy it as the owner. You just issue a bond and someone lends you the money and you now own it for free. Well, on other people's money. Yeah, you got to pay them. And who makes those types of private investments? Somebody that has a lot of cash that wants to sit on it for a long period of time and earn a small amount of money. And that's like pension funds, for example. Insurance companies, for example. Okay, so that's an interesting little slice of the world, right? 500% bigger than muni bonds. You know, and right, so the stock market is tiny, and then the bond market is huge compared to the stock market. There's so much more money in the bond market. And then you can go into the subsector of, you know, much more money goes into, you know, into real estate than into loaning it to your local municipality, right? Because many of these guys running your cities and your towns, you know, at best they have a college education, but more likely they're Instagram models. And now they run your small town. So That's fine. In fact, we talked about that in the swing trading group last night, how to do proper research. That's such an esoteric question. Obviously, I can't answer that in a live stream. But there's all kinds of places you can get the information. Government websites, central bank websites, corporate websites. Like this morning. Okay, this morning, it's a Friday morning. What was I doing? I was reading a brand new research paper issued by the Fed, focused on the imperialism of the US dollar and how it creates vicious and virtuous cycles that self-reinforce. So that's what I was doing over breakfast. Probably still on my phone. Here it is. Look, I won't bullshit you. I won't bullshit you. Look, it's on my phone. Huh? These are some of the cycles, right? Look, this is what I'm doing this morning. I'm going through all of this. I'm reading. I'm learning. I'm growing. Oops. And I'll get you to the front page. Okay? Written by, it's a staff report. Look, the dollar's imperial circle by the Federal Reserve Bank of New York. So, stuff like that. Can I tell you how to do it and how I do it? Yeah, that's an example, real world example. I'm always on, baby. It's one of these things, you have to know everything. Now there's let's say economic data, and then there's high frequency data, and then there's more like research. The high frequency stuff is everything that's not basically pre-scheduled on a regular basis. So let me give you hang on. No, I gotta switch accounts. Hang on. So the first thing, it would be quantitative analysis of economic data for the formulation of a macroeconomic bias. It's that easy. So how do you very quickly know everything? You have to have good data. Okay? Okay? So then you can go boop, boop. And now I know everything. I see the technical analysis, future projections. I know seasonality. I know the difference between Canada and the United States for growth, inflation, employment, interest rates. I see the difference in retail sentiment and institutional sentiment. Okay? It's all organized and scored. So that makes it easy. But is that everything? No, that's quantitative analysis of economic data. Again, it's retail positioning, institutional positioning, fundamental analysis, seasonality, technical analysis. It all gets put into there, and that's that. But there's high frequency data that you might want to look at, like like credit card spending. Okay. Let Freedom Ring says, how can you get good data when the data gets manipulated? Which data gets manipulated and by whom? Because, like, that's that. GDP in the United States versus GDP in Canada. Who's manipulating what? NFP all summer? I didn't see any manipulation there. Right? Because you can look at things like, so when it comes to employment, jobs, okay, we'll call it. What do we look at? NFP, obviously. Okay, weekly jobless claims. And we look at ISM services, for example, the employment subcomponent to ISM. Okay, you could even look at another dumb prediction, ADP. They're all independent from each other. And what they told us independently, using even NFP, is two different job reports. One is from the establishment survey, one is from the household survey, using different methodology and collection and all that kind of stuff. But nonetheless, and then weekly jobless claims are literally how many people are requesting money from the government because they lost their job. I could even throw in one more, okay? The challenge, oops, put this in black. I think it's Challenger, Christmas, and Gray layoffs. Okay, so this is starting to show that there's an increase in mass layoffs, but ADP is still showing growth, ISM growth, weekly jobless claims growth, or NFP. Or you could argue in other ways, more like flat to flat to flat to flat. But what they're not saying, remember, these are all different methodologies, different research, different numbers, but they all end up talking about jobs. What they're not saying is, right, this methodology is showing a collapse in the job market. This methodology shows a collapse in the job market. This methodology shows a collapse in the job market. Remember, this is a survey of purchasing managers. Okay? This is small and medium-sized corporations that hire this company to do their payrolls and their benefits and their taxes. Like, they're all completely different things. And what they're not showing you is a collapse. So, again, that's where I go back to, like, okay. So, let freedom ring. If you're convinced it's manipulated, you better get some information or evidence of it. Because, again, these are all completely different entities. And, of course, Challenger, Christmas, and Gray, which is a headhunter company, they do these researches. So they talk to their customers, and their customers say, yeah, we're laying people off. Again, that's a high... NFP is not high frequency. Okay? But the Challenger, Christmas, and Gray is a high frequency data point. It's not a government issued thing. But they do try to track that. And that does show more mass layoffs are happening. But where? In NASDAQ companies? Yes. In other companies? No. So it's not a broad indicator, but I think you could argue that based on all this research, most corporations are not laying people off. They may not be hiring people right now, and maybe some sectors like banking and high tech maybe are laying some people off, but the market hasn't collapsed yet. But look, here's what I'm getting at. I mean, you need to know what you know versus know what you think. So I don't know if you're right or wrong, but here's the thing. Get the facts first. But if you think it's all manipulated, you shouldn't be investing. If you're being lied to, you're not in control and you cannot make logical decisions. So you should remove yourself from the market. But maybe you're already a prepper. Maybe you're living in a cave in Montana with food and water, guns and bullets. And I don't even mean anything by it. But what I mean is you need to withdraw from the market if you think the market is rigged. It's the only logical response, and I think you would agree with that. Same thing if you think the society has collapsed, you should withdraw yourself from society. But it's certainly not helpful if you're going to trade the stock market or something and you're like, but it's all rigged. Then you shouldn't be trading the stock market. You'll never be able to make a decision. So you kind of have to love it or leave it, take the data at face value. And remember, we're not trying to outsmart the market. If the rest of the market is stupid and they don't understand everything's manipulated, then who cares if they're stupid and they don't understand as much as you do? They're going to make decisions, rational decisions based on their misinformation. And then you can predict on how they're going to trade. Even if they're misinformed, it doesn't matter. If the stock market's going to go up because the numbers are rigged, then dude, buy the stock market and make money. It doesn't have to be right. You don't have to be right. You just have to do what the market's going to do and go with it and be able to kind of understand their logic and their process to making a decision on how to deploy their capital. So if you think it's an up day, even if they're dumb, buy it. There's no right or wrong. There's no good or bad. Who cares if it's all manipulated? That doesn't have any... Who cares? Like, literally, doesn't have... Who cares? Whatever. It's all good, man. Okay, but I can tell you, in the middle of COVID, every single small business in my town had a help wanted sign. And I talked to as many people as possible, and business owners, and were every single one of them, every one, was trying to hire people. So, but this summer, I don't recall anybody telling me that they're laying people off. Okay. So I'm like, my ancillary, research of just talking to people around my neck of the woods, I didn't see the collapse hitting. But, it might be coming. Sure. The BLS, the Bureau of Labor Statistics, reported that the U.S. economy saw a net gain of 1 million jobs in the second quarter, per Washington Times. Well, the Philly Fed contends the figure was actually more like 10,000. Okay. Well, we'd have to look at the numbers for us to understand, because they may not be measuring the same thing. So we'd have to look at it. So that would be the right thing. Like, I like that, right? I like that thing. Good. So we'd have to look at it and compare it. Okay. But you remember, the BLS might be using one methodology, the Philly Fed using another methodology. Very often the reporters at newspapers misreport things or don't understand this. So maybe the Washington Times is wrong. Like, there's a lot there, but like, cool. Like, I'm not saying you're wrong. I'm just saying ultimately it doesn't even matter, because you're not trying to trade what's right. You're trying to trade what the market is doing. Yeah, Richard, I cover business cycles quite heavily in the macroeconomics course. Right? Covered that. If you guys are with me, I don't know, over the years, right? You'll remember that there's, Y star. Okay, and Y. Okay, and we used to do you remember this one? Does anybody remember talking about this and what it means? What do we call this area here? Well, this is Y star and Y, so we're not measuring recession. Now you can argue that, well, in that scenario there is a recession, sure, but that's not what the chart is labeled. What is Y? Y and Y star. Well, we could relabel these. Okay. Oops. Yeah. No, not, I mean, they're all related, but yes, GDP, nominal GDP is what Y is. But no, this, and we talked about it quite a bit over the years when we were in this gap, by the way. This is a productivity gap. Okay. And so we were in that part of the business cycle quite time, and I was teaching this while we were there, and what it means and where we need to go in the future and all that kind of stuff, and what it means when we're there and what it means that we're there. Okay. That's a productivity gap. And so, where are we now? Are we here? Inventory to sales ratio, sure. In many cases, inventories are up, yep, which would be disinflationary. But you don't typically get those until you're down in here in the cycle. Okay. But you could look at the gap. You could look at Nike. You could look at, all that kind of stuff, right? There's, yeah. Capacity utilization, yeah. Yep. You could look at that because if inventories are going up, yeah, then factories are going to slow. So productivity, capacity utilization and productivity of factories would decline. Yeah. And all that's reported too, by the way. This is all just free information. Where could you get inventory data? Can anybody tell me? How do we get that inside information, whether corporations have high inventories or low inventories? Or maybe you can't even get that information. Is it ungettable? Okay, I've spent less than 1 minute getting it for you. But what can I do in 30 seconds? I can give you inventory data for manufacturing companies in the United States. How do you feel about that? The inventories index registered 50.9 of 18 manufacturing industries. The 8 that reported higher inventories in November in the following order. Non-metallic mineral products. They have too much of this stuff. Electrical equipment. There's your GE maybe. They have too many of them. Appliances, components. Why? People aren't buying houses because they can't get mortgages or they can't afford the 6% mortgage, so they're not buying new appliances. Plus maybe credit card rates are up, so they're not going to make... But what do we call this, by the way? Appliances and components. Durable goods. Miscellaneous manufacturing, primary metals, machinery, CapEx. Computer and electric products, high tech. Transportation equipment, chemical products. Okay? So half, almost half, but basically half, of all manufacturing industries in the United States have too much stuff in inventory. So they're not going to ramp up production in January, are they? We need to make more. We already have too much. So what does that do to prices? Well, they're going to have to dump this stuff. Sell it. Sell, sell, sell! Now, we might find by the time we get to January and February that there's a lot of stuff at retail that wasn't sold. So you didn't buy your ski pants and your mittens in December? Well, what are they going to do with them in March? Everything's half price, bro. Everything. Good deal for you, bro. Huh? What do you stink? Does that smell good? You're just like an angel. Your skin makes me crawl. So if you want to look at it from a higher time frame, of course, that's the move that we're looking at. and you're kicking off the moving average. That's how you do a trade for tomorrow. Okay, now we got a question about what's the schedule next week. You know, I always forget there's holidays. I don't freaking know. I don't think the markets are open Monday, are they? I don't think so. So we'll have to just gather on the 3rd, which is Tuesday. Wednesday, I'm going to do the 2023 Outlook. Remember, anybody can join, all members of FX Bootcamp, but non-members of FX Bootcamp. But you got to have a golden ticket. And the golden ticket costs $10. Okay. So the link is here. Somewhere around there, I also want to launch the super secret fundamentally based alert service. I just don't know if I have time, because then it's Thursday, and Thursdays are tough. Awesome days, but they're tough. And then Friday is non-farm payrolls. And then Saturday, I'm at the Tropicana in Havana, Cuba, dancing in my yellow thong and feathers. Maybe some balloons. Yeah, I think it's called an internship. Yeah. But let me tell you, being a Canadian male, one thing is for sure, I look good wearing yellow Speedos. Like all Canadian men. We were just meant to be in warm places and show off our bodies. That's just how it is. Hey, don't hate us. Huh? It's just how it's just it. It's just, that's that. At least I lost some weight. About 2 years ago, in the middle of COVID, if you saw me on a beach, you would confuse me with a hot water heater. I look like a white cylinder. A can of milk. A bottle of milk with legs. Right? I look like the A&W root beer guy. Or maybe it's the marshmallow man from Ghostbusters. Yeah. So anyway, luckily I dropped 40 pounds. So great. So Tropicana, here I come. Yeah. Yeah, looked like Hulk Hogan before he became Hulk Hogan. Macho Man. Yeah. I'm the world's best. Yeah. Anyways, so I got to go, babe. It was real. I thank you for being with me in 2022. I appreciate the camaraderie that you share and the focus and the drive and your passion. I love this thing, and I love this thing with you. So thank you for being on the journey. Remember, it all started many, many years ago, almost exactly 20 years ago. I realized you can't do this alone. You just can't. Right? You just can't. You can try for a while, but you'll end up in trouble. That's why you get even guys like Greg checking in on a regular basis. He's been doing it for 40 years. Yeah, he doesn't need my advice, but there is a value. And so I appreciate him in the community. I appreciate you in the community. I appreciate us as a community. I think this YouTube channel is real. I think it has real impact. I try to give you real and useful information. It's not a get rich quick thing. It's not a rah, let's scalp. Oh, look, I just made a bunch of money on my phone. Look at that. What, you don't even have a laptop? Right? So anyways, I want you to succeed. And ultimately, I want you to be happy. So I hope I, at least in some way, contribute to your success. And remember, I measure success, right, as GDP. And I tie GDP into self-worth and self-dignity. And so I hope when we work together, it ultimately increases your productivity. And brings you peace, happiness, and joy, or at least, a nicer bed, a safer neighborhood, a more fuel-efficient car, and a watch that you never wear. If that makes you happy, great. Let's do it together. So peace on earth. May the pips be with you. May our profits be above average. See you next year, eh?